After months of waiting, lower rates and steady buyer activity are finally reshaping the Ontario real estate market. Now, the question is this a real shift or is it just a short term bounce? In this video, we're going to break down where the real opportunities are this fall. From a macro perspective, borrowing costs are down roughly 100 to 150 basis points from last year around this time, definitely helping affordability tick upwards. Now, as inflation continues to cool, albeit gradually, buyers and investors are finding a little bit more breathing room, hence why I think we're seeing an increase in activity in the real estate market. Although the headlines will tell you sales prices are down, making it seem like doom and gloom, I think the reality is a lot of sellers out there are tired of waiting and have been reducing their prices to find the market. And lo and behold, the buyers have been there. Nationally, sales volume has been steady, plus 1% month over month, and new listings are up slightly, and months of inventory hover at around 4.5%, suggesting more balance and not frenzy. Now, what does this mean for you? It means that confidence is returning, but buyers definitely still have some leverage. Also, headlines tend to focus on what's happening in Toronto and BC, but what we have the advantage of is having some insights into some primary, secondary, and tertiary markets that might be a lot more similar to the place that you actually live. And the real estate market is performing very differently in all of those markets. If you're new to this channel, I should tell you that our team covers also residential, commercial, and investments all across southwestern Ontario. So London being the heart of that market. Fun fact, London is actually a test town. So a lot of huge companies around the world will use London as that test market. So why don't you use it for the real estate insights that are happening in the London greater region? But the fun part about what we do is we cover areas like Port Stanley, St. Thomas, Grand Bend, Bayfield, Woodstock, everything all the way down to Sarnia. So we have a really good idea on what's happening in very different types of markets. Speaking of which, what market are you in? How big is your population size? Are you more rural? Are you more urban? Are you looking to relocate? Jump in the comments. I would absolutely love to know who is watching these videos and what information can best serve you. Back to the data. In September, sales were up 2% month over month, strongest since January. And I think in large part that's because we've seen prices coming down. And the benchmark price, $970,000, down slightly year over year, showing a soft landing, not necessarily a slide. I would also say it's really important to note where your house is located. That may not be the case. Your values may have gone up. So if you're looking to sell, don't just give the farm away, but also be realistic in your price points. From the buyer's perspective, negotiating room remains thanks to healthy supply, and there's definitely good opportunity to lowball people. But keep in mind, not all listings or selling agents are created equal. Now, what are some of the opportunities we're seeing in the marketplace? Definitely upsizers, because keep in mind, as prices are going down by direct correlation, if the prices went down on a $1.5 million property, but you're selling a $700,000 property, sure, you may sell that $700,000 property for a little bit less, but you're getting way more of a discount on that larger property. Another opportunity is I would also watch out for the Bank of Canada's next announcement and see if they signal another move before the end of the year. Now, I'm going to give you some data on some of those areas that I mentioned that we cover. In London, St. Thomas, sales were actually 10% up year over year, and inventory is at about 5 months, which is the highest in a decade. But 4 months of inventory is actually balanced, so not that crazy. The average price is around $650K, very stable month to month, and the market feels balanced with plenty of selection. Now, the plays in this type of market, move-up buyers can be patient and strategic. I'd also think new home construction is a big opportunity for people. Because the delta was so big between new construction and resale homes, a lot of people were choosing to go with renovation projects, but I'm telling you, people are getting sick of renovating kitchens, bathrooms, and basements, and are starting to call us more on our build sites. I literally just got off the phone with another person looking to build in the north end of London, so that's definitely something to pay attention. Now, in Sarnia and Lambton, sales volume is actually up 25% year over year. Inventory is at about 4.5 months, so a little bit more balanced than London. The average price point is about $525, slightly lower year over year. I think balance conditions in Sarnia are perfect for cash flow investor. I think you're going to see some duplex conversions and vendor take back and creative deal structures on some of the larger multifamilies that we're involved in down there. And there actually are quite a bit of off-market and estate sale opportunities if you know where to look. Now, Chatham-Kent, the sales volume is actually down slightly year over year, but the inventory is actually up, creating a solid buyer point of leverage. Average price is around $440. I would say from a strategy perspective, turnkey listings will move more quickly in that type of a market, and price discipline matters. And for farms, development parcels, we're actually seeing from the bank side of things that they're asking for longer due diligence periods. Also, I am seeing some builder incentives in and around that area. Some of our recreational markets like Grand Bend, Port Stanley, and Bayfield, year to date, sales are down about 25%, prices down about a half a percent. But again, it depends on the asset class that you're selling. Some of the prices are up, especially in the luxury price points. But the stuff that's called at 600 to 900, we've noticed a declining market in terms of where comps are being set, which changes the pricing of everything else. So if people are not desperate to sell, some will take their properties off the market and relist next year. It is really a case by case situation. But I think there's some good opportunity zones for waterfront or water adjacent homes where replacement cost is much higher than what the purchase cost and rental cost is today. And there's going to be some smart plays in short-term rentals and multi-generational setups. And I would say expect the best deals in shoulder season. Like if you want a cottage for next year, send me a message right now. There's some incredible options that are not going to be listed until the springtime, and there's just not as much competition. Now, in terms of who should be actually taking action right now, I think buyers, because there's a sweet spot between lower rates and ample selection. I would say definitely lock in rate holds or float your clauses and keep financing conditions in play. And if you're looking for the lakeshore areas, focus on some winterized older stock where improvements are quantifiable. And as a buyer, you have more ability now to negotiate some closing credits for repairs and upgrades and just have a little bit more room to play given that there's so much on the market. Now, for sellers, I would say price with precision. Don't just hope for 2022 prices. Use the last 2 to 4 weeks of sold comps as your current actives. Look for pre-listing inspections. Try and prepare your property as best as possible. And I think staging is an absolute must in this market, unless you have a very unique type of property. For investors, I'd say look at duplexes and multifamily. There's some great deals out there that I know people would have killed for years ago, but underwrite for stability, assuming 1 to 2 more modest rate cuts. But I would still stress test your deals, like add 150 basis points to whatever the rate is that you got, and ask yourself if that math still makes sense. And I'd say also look for builder incentives, vendor takebacks, and small infill sites that are ready for density. For builders and developers, London St. Thomas remains very attractive for small lot custom builds and gentle intensification. We are going to want to see more absorption, but I feel like a lot of the conversations we've been having lately have been people planning for 2026. So I wouldn't just sit on my hands and wait. The months of inventory in the development space is about 5 months. I would definitely get creative though. I'd consider appliance, landscaping credits, rate buy downs, whatever you have to do to get people's attention and get the conversations going. Now, if you're looking for off-market inventory, farm parcels, or global referral opportunities, you can connect with me as well too. We have prime partners literally all over the globe. I just got off the phone with somebody from Arizona who just did a relocation for a Canadian coming down from Calgary. So make sure you're leveraging our prime partners network. And if you're in our territory, whether you're doing residential, commercial investments, or agriculture, definitely connect with me below. We have one of the unique systems for both buyers, sellers, and investors, and would love to connect with you and make you part of the Prime family. Hopefully you enjoyed some of the data that we gave you in this market update. Make sure to give me feedback in the comments. Where are you from? What are you trying to accomplish? What data points do you want? And I'll make sure we give it to you in the next one.